Okay. All right. Good afternoon to all those of you on the West Coast here. It's 1 o'clock, I guess, early evening on the East Coast. I want to talk today. So it was, this was sort of an interesting topic. This, Fib and Elliott Wave stuff is definitely interesting. I'm not the most technical of traders when it comes to using indicators of any sort, but I do like fib levels. I like things that give me some predictive validity, and I use all of this stuff in the bigger context of we are order flow traders. And David was asking about Julie. Julie was we've got a little bit of stuff going on with our son in school today, so he's 14 and in the midst of getting back to school, so she's handling that. But we have been what you would call order flow traders since 1997. So we started way back 25 years ago. We have spent a lot of time down at the exchange. We've done a lot of sort of data gathering, data mining from good information that we got from NYSE. We were very focused on NYSE trades almost exclusively when we started trading. We've added NASDAQ trades over the last 10 or 15 years. Ever since ARCA took over at NYSE, the things changed a little bit, and it became more of an electronic exchange. But the data, the numbers that we crunched originally are still very valid and really just fit into these patterns and order flow trading models that we use. So that's what I'm going to focus on today. So I'm going to take one little tidbit of what we do, which is order flow trading. And you can use stocks, futures, options, depends on which instrument you're using. If you're trading the index, obviously you can do it with futures, options, or directly via the spiders, diamonds, Qs. Or if you're trading the stocks, most likely you're going to be trading either the stock or a stock option. But all of these strategies work in these various venues. We have done a lot of education over the years. You guys who know us know that we have been around for a good long while. We do some teaching. We have some trading plans that we've been publishing for the last 22, 23 years. And so we've just been around for a while, and we limit our teaching to some very small groups of people. We do it with about 20 people twice a year. It's not our primary business, but we like to be out there teaching. We're both PhDs, MBA, PhD. We were both out at the Drucker Center and at the Claremont Graduate School for degrees in psychology. This is typically something you do when you want to teach, and we did want to teach. And then we got into this and just never turned around and never held a job doing anything else. But about 15 or 17 years ago, I guess, or maybe even longer than that, we were approached to start doing some of these live conferences as trading became more mainstream. And that was really great for us, because then we got out there and we got to do the thing that we originally set out to do, which was interact with some people in a way besides just pushing money around at our desk all day. You can see here I've published a bunch of stuff. There's things that go beyond this list, of course, and it's just important, I think, to get your ideas out there and to be transparent about how things work. These are all articles either written by me or articles that were written about me and about Julie and about what we do. And then, of course, we also wrote some books on trading. So Around the Horn, A Trader's Guide to Consistently Scoring in the Markets is the basis for pretty much everything we're going to talk about today. That's out of print right now. I owe the publisher for about 8 months now a new version of that book, and I'm going to get it out there. I'm telling myself I'm going to get it out there, but right now I'm a little bit behind the curve on getting some of these things done. Trade Secrets, that was a deep dive into an expansion of range and volume trade that we love, something that was sort of the cornerstone of our business and the first building block in Around the Horn. And then World Cup trading and Beat the Street and Trade Secrets, those are all just worldwide copies or versions of the book. So the book's been really interesting and got us out in front of people, and it's been a great experience to have so much connection with people when you're really working in what's sort of an isolating business. So trading can be a little bit of a grind because you're just sitting at a desk all day and staring at screens, but the screen time is so important. So we try to divide our day up so that we're here for the open, we're here for sort of the midday, and then we're here for the close. The rest of the day we try to, as I said, we live in Pacific Palisades, so we try to go hiking and we try to get to the beach and do all that kind of stuff and break the day up a little bit. But ultimately, you need to be in front of these things to really understand how they work. And you're going to see that in some of these patterns that I show you in a minute here. So I mentioned our training, and I want to show you just a picture of a couple of these boot camp things that we do. And the reason I want to show these to you is to bring to your attention the variety of people in those rooms. So as I'm looking at these screens, I see a biomedical engineer, I see an architect, I see a policeman, I see a doctor, I see a lawyer, I see a farmer, I see people from all sorts of walks of life. We've got a photographer sitting in the back of the room there in a red shirt, a food photographer, right? Fascinating guy too. And what all these people share in common is they want to do this thing. And what they all bring to the table is their own individual psychology. And really a lot of what we do in this training is we put people first in front of the method, in front of what we do and how we do it. And there's 700 pages of documentation to go through and weeks worth of online training. And then there's this live event. And the live event is 4 days down in Miami. And that's where we kind of dig into what's holding people up and what are they happy with, what's holding them back. I can tell you whatever your personality strengths are, those are the things that you tend to focus on. And then those are the things that tend to make trading difficult. And if we're good at something, we assume knowledge is transferable and we can go, I was great in graduate school and I was a great PhD, I was a great psychologist, and I'm able to transfer those skills directly to trading. Well, you're not, right? It's not like that. Trading is about understanding the thing that you're right in front of in a way that you don't understand anything else. So with that being said, we all tend to like an indication. These guys all come to the boot camp and they'll ask me, what do you think? I've got an RSI and a stochastic, and I've got these oscillators and elevators and all these things that I like to look at. And I always come back to those things don't really help me trade. And I doubt that they help you trade either, because most of them tend to fall into the category of being lagging. They provide data-driven representations of what's going on. So you get a moving average on the chart, you get a momentum indicator on a chart. If it's going up, it represents one thing. If it's going down, it represents something else. But really what it's telling you is what happened 5 bars ago, or 10 bars ago, or 14 bars ago. And that's not going to be useful in terms of figuring out really what the dynamic of the order flow is right now. Julie and I were primarily non-directional traders when we started in this thing. We still tend to be pretty non-directional. We have to be, some of the market makers we've worked with, we've trained guys who were finishing careers as market makers and wanted to trade on their own. They want to be an upstairs trader. They want to trade their own account. They're going to go sort of the retail side of things. And they come to us completely non-directional. They don't care. The market's moving up, down, sideways, doesn't matter. The only thing that matters is how many shares they're clearing. And we'll tell them this is going to be what we do is relatively similar, but we have to be right directionally for just a very short period of time. You're going to see here on these trades that I show you, on this particular trading style that I show you, what I mean by that and how we set those trades up, and how if we're right for just 10 or 15 minutes, we can make a living doing these trades. So I like to look at leading indicators. So I like to see things that are giving me representations of future support and resistance of things that haven't happened yet. Where's the order flow going to be? Where's there going to be support? Where's there going to be resistance? Where was there volume? Exactly volume at certain price levels, not volume by time levels. Time is important too, but when you divide the market up by time, it's an artificial construct. You're only seeing things based on how many minutes do you want rolled into a bar. So we're going to look at volume by price. And when we put these things together, what we really manage to do is get probability in our corner. And to me, this whole thing is a probability game. We're all out there looking for, if you're trading options, if any of you here are an options market maker, what are you doing? You're taking bets, right? You're going out and you're offsetting all the risk on all the trade that you've put out there by buying the stock. Right? We all know what the impact of that is on the charts. We all know where we can see unusual options activity. All that stuff provides opportunity, but really it's a probability game. And it's all about controlling probability and then getting in and managing to take volatility and remove it from the equation as a bad thing, and instead add it to the equation as a good thing. We're going to anticipate the effects of volatility. We're going to anticipate what volatility is doing in the market, what it's doing to the trades that we're setting up. And there's a couple things that you need to consider. So if you're trading options with these techniques that I'm going to show you here, or with these trading plans, it's not going to be easy to trade options even on these super cap stocks when volatility is super high, because as volatility gets to be better and better, let's say, or it increases, it becomes very expensive. So this is where some of you will have big slips on the stock options when you're looking to do this type of trading. Not so much on the indices. The indices are better. The triple Qs, the spiders, the diamonds, those things are trading enough liquidity that they're not really affected. Same holds true for, let's say, Apple. Apple gives us, we have a whole sheet of volatility bands that we put out every day for our guys who are subscribing to this stuff over the years. And what that does is says, look, Apple is unique. Apple is a very unique animal, and you can go and trade this pretty much with the same spreads you're going to get on a stock, even if you're trading the option. Some of this other stuff that I'm going to show you, Microsoft and Netflix and Tesla, those kinds of things, is just better to go and trade the stock directly. What we look to do is isolate volatility. And we want to isolate volatility into pockets that represent tradable ranges. And this is what I was talking about when I said we're looking for 5, 10, 15 minutes worth of confirmation in our data. And that's where we're going to focus our trading. And what that involves a lot of times is sitting on your hands a good portion of the day. So I tell people all the time, sometimes the best use of your hands is as a seat cushion, because most times that you get bored, your fingers are going to, don't let your fingers do the walking, because they are going to make you your own worst enemy. We're going to trade a very, very high liquidity stocks for this strategy. So the NYSE strategies that we use, low liquidity stocks, right? Those are 300,000 shares and up to, maybe about 1 million, 2 million shares. That's a totally different trade. Those cycle trades are entirely different than this kind of an order flow trade. And we're going to wait patiently, as I said, for these very predictable reactions that we're going to see to order flow as the day goes on. And we're using yesterday's order flow primarily to predict today's order flow. So here's an example. This is an older slide here, and I'm going to show you today's plan so that we get current. I'm going to try to keep everything in terms of, here's a slide that I set up, and then here's what happened actually today. So here's a slide that I set up in July when I was showing somebody this. Microsoft, Netflix, Tesla. We're looking at directional volatility isolated from yesterday's trading. So here you see, in this case, what we had was Microsoft set up as a short. The order flow that we were looking at was from $265 a share down to $264.01. That's a first threshold where we're looking to take money off the table, or we're taking some profits. $264.01 down to $263.44, and then $263.44 down to $262.37. And the way that I'm putting these things together is I'm going in today at the close and setting these up for tomorrow's trading. So I'm looking at where were the markets made in the stock over the course of the session. Where can we go and isolate volatility and say these ranges represent the place that order flow took over the trading. So no matter what else you thought was going on, when you looked at the tape, you saw almost a void as price hit a level and then moved through to the next level. And the way that I do this, so I use a piece of software called Realtick. I've got no relationship with them other than I used to speak on their behalf and show institutional guys how to use it. It's primarily an institutional platform, but it allows me to chart volume by price according to an algorithm that actually goes and segregates pockets of liquidity. So this thing changes over the course of the day. The volume by price out on that right axis there will shift as time goes on and show you where the most important volume up to that point in the day has resided. So in this case, when I go through and I'm putting this thing together for the next day, what I'm saying is this box right here, which lines up with that purple arrow, the top one on the left, gives me an indication of where the first pocket of liquidity is going to be the following session. So if the market opens and the bias continues to be on the short side, I'm going to have an opportunity to short 265, and I'm going to look for 64 spot 01 or 4 spot 01 as an exit. And then the next level that I'll look to get in at is 01 and 4 spot 01 down to 263.44. And then 3 spot 44 down to 262.36. So if you're looking out at that right axis and you saw that box moving, you should see that those are definable histograms of price. They look like their own curve. They look like their own data set, their own sort of bell-shaped curve. Lets you know that's an area that something is likely to happen. The next day, Microsoft opens. And we've got futures that are soft right out of the gate. Microsoft opened a little bit higher. I'm always looking for confirmation. This is where we're going to get into the fib stuff in a minute. I'm always looking for confirmation from a number of time frames, from a number of different indications of what's happening. But this is just the basic trade. How would you put the trade off? 265 represents an entry. And then all the way down to 262.36, you have potential exits and re-entries, or on a big opening move, when you see that the market, when you see the futures are selling off pretty hard, and you see that the stock opens and careens right through and hits that first entry line, you've got a pretty good opportunity to leave the trade open and take the move all the way down into, we call it through the bands. My guys are famously saying, we got all three bands, we move through the bands. And what you want to make sure of, if you're setting these up for yourself, is that you understand the correlation between the securities on your trading plan and the market that you follow. So I'm looking at, most of the time, I've got Apple, I've got Microsoft, Netflix, Tesla. Sometimes, Tesla's been sort of on and off of this plan based on the price level that it's trading at and the way the spreads are. Sometimes Tesla can be extremely volatile just because of the spreads. It was trading at $900. 987, at one point. And, when it's trading that high, those spreads got pretty crazy, and the liquidity from the bid to the bid, right? When you're going down a level on your level 2 screen was as wide as the entire spread from the bid to the ask. And that's where it would tell you, we might have a problem here. So I'll substitute in NVIDIA. You can go through and just find any stock that's super liquid and has a known correlation to what's going on in the market. So you can just run a correlation coefficient, or you can eyeball this. So you could run a Pearson's in a spreadsheet, very simple thing to do, find out what's my correlation, or better yet, spend some time in front of the screen and just learn the personalities of these stocks. As I said, Microsoft, one of our favorites. So here it was again, today it was on the plan as a short. So we had 254.62 this time, down to 254.01. Down to 53 spot 18, down to 2 spot 04. So you had those bands set up as the potential travel range that we would see if Microsoft got down into these ranges. So here's what happened this morning. Now let's start looking at some correlations, and let's look at what else do we keep an eye on when our trades start approaching entry prices. This morning, we had futures that were higher, and we're looking at a short sale in Microsoft. And you see that the futures opened right above their central pivot line. That's that red line on, I put the Qs up since a lot of you might not have a futures data feed. So the Qs or NDX, that's going to be practically the same set of data when you're looking at it. And you can see here, we didn't take this opening trade in Microsoft because the triple Qs and the NDX were taking straight off to the upside. We had a big move higher in the morning. That said, to just hold off a second. This isn't going to represent our first trading opportunity of the day. Same thing happened with Apple. Apple would have been a long first thing in the morning, but it was way up and out of the bands that we had looked at for it. So in this case, we just pass on that first trade. But a little bit later in the session, as the triple Qs came down and started testing that central pivot line, now we'd already missed that 254.61 entry. Down to 254.01 was going to be a done deal. That's not going to pick us up. But we do have a chance then to get short 54.01, and we're looking for a target down around 3.16. And I think we were actually closer to 20 was where the level was drawn. This, well, we'll see here in a second, I think. Yeah, here's the order, the live order on this one. So you can see we just had 500 at 3.98 at $253.98. And at this point, it's already moved 50% of the distance down to the profit target. So we've pulled our stop to break even. And this is rough. So a lot of people focus too much on the minutia. Well, you said break even, but you've got it at 97 and the entry was at 985, right? So 253.99. So how do you adjust these? You just pull the lines until you're drawing these lines. So you're just pulling those lines down on top of the lines you drew as best you can, and you don't worry about it if you're off by a couple pennies. And you see there, 253.20 was the level that we had our exit order on the short sale. And what we had was the cooperation of the futures that lined up with that Microsoft trade, and it got us into a position and out of a position for a nice profit. And we had this opportunity again and again over the course of the day. I'm going to show you, because I notoriously run out of time and people can't get in. If you guys want to do that trading plan, it's traderinsight.com/VB-plan. That's where you can find it and sign up for it. And today's sort of event special is a 25% discount on the monthly subscription cost. It's going to be, I think, $150 a month. If you can't make the $150 a month pretty regularly over the course of the month, it's not for you. So this is something you just have to look at and say, is this a plan that makes sense? Do I understand what he's doing? We provide videos almost every single day about all the trades that were done, about the logic behind them, about how they were handled. And really, it's a learning tool, and it's just there to get you in front of opportunity. So now let's move on to the indices. And the indices are nice because you as a trader have undoubtedly got a preference as to what it is that you like as a vehicle for your trading. So I get guys who, oh no, I have to do it with options. If I can't do it with options, I don't want to do it at all. Or guys who do the futures, and if they can't do it with futures, they don't. And others of us who only want to trade stocks, it doesn't really matter, because you can trade against the indices, obviously, with either a sector holder or an index option, or with the futures. And what's nice about trading things like the triple Qs is what you're going to capture is a lot of the momentum of things like Microsoft, of things like Apple, of things like Tesla. What you have to go and focus on is, if the underlier, if that stock is the thing that you've got an eye on, what's the correlation between the stock and the triple Q, or the stock and the SPY or the DI. It's all about how closely does it mirror the move. So I know, for example, Microsoft on the short side of the market tends to fall out a little bit quicker than the index, which is good for me if I'm going to look to be short, because it gives me the opportunity to look at the index and try to figure out, as I did in that last thing, is it coming right into a pivot line? Is it, because if Microsoft's going to take off and trigger my trade, while the Qs are hitting the central pivot, and then it's going to have an inflection and Microsoft lagging a little bit, then I know I'm probably going to get popped into a trade just to get popped right back out of it again. The stops on these are tight, right? The stops on all of these trades are going to be tight also right at natural support and resistance. So you have a very tight parameter on the trade. You don't want to get popped in and out of it over the course of the day over and over and over again. You'll see here today in the Qs, I think we had 3 or 4 trades. They tend to move very geometrically, and this is where the fib studies come in. This is where you can use fibs and Gann fans and all that good stuff to go and find yourself some confluence of indications. Where do things overlap in terms of what I'm expecting to see during the trading day? As I said, we've got quantifiable correlations so that we can tie this to the stocks that we're interested in watching. You can use the triple Q as one vehicle, and you can have the stock another. So typically I tend to focus on Qs and Tesla and Microsoft during the day. Those are really my favorites. Qs and Apple first thing in the morning. I've got all these things sort of isolated in pockets of what time of day is it, because what I know for sure is on the index, the part of the day that most of you hate, that 11:15 to 2:15 time, right? That New York lunch is really my favorite time to trade these. And I'm going to show you why in a second. So Qs, diamond spiders, as I said, low slippage. And if you want, you can use the option, you can use the NU, you can use the future, you can use the E-mini, and you can get in front of these for a lot more of a levered position than you would with the cash, with the security. Now, I would say when you're managing your risk, what you want to do is say, if I was getting into a triple Q position and I was going to buy X number of shares because that's what I'd be comfortable doing, how many dollars am I comfortable losing there? Am I comfortable putting at risk? And then go and scale your risk in the futures or the options so that the magnitude of the loss is not more. Because where some people wind up getting just creamed on some of these things is they like the leverage that these other instruments provide, but then instead of using the leverage to just trade the same size position with less money, they go and scale up, and they scale up too soon, and they wind up, the light at the end of the tunnel might be a locomotive coming right at you. So that's always something to think about when you're putting these trades together. Here is triple Q. So this is from a little while ago, but this shows the logic behind sort of everything else that I'm going to show you as we go through the rest of the session. First thing I'm doing is I'm isolating where I see support and resistance. And I'm doing this by, you want to focus on the chart. You want to look at where the stocks line up, where the tails, where the highs on your stock chart, and also out on the right side, where are those volume by price thresholds. If you don't have access to that data, then focus back in on price data and use price data alone. Most charting software will allow you to plot volume by price, sort of true volume by price, not this algorithm where it just shows you at every tick, here's how many shares went off. That would be my second choice to this algorithmic kind of volume by price. But you can see that I go through and I just isolate for my trading exactly where I see that price is going to inflect and that order flow is coming into the market. So we're just looking at, is there order flow at a level? Is that order flow giving us a threshold level that says if we sort of rest here and find support here, then we can expect the price is going to take off. Again, this is algorithmic volume by price, and we see that it forms these nice pockets that line up and make sense. You can see right, each one of those has a very different profile than the one right next to it. There's a very distinct thing that's going on in that volume by price data where you can see them as 4 separate events happening out on the side of the chart there. That's what makes this useful as a predictive tool. Then I'll take the morning and I start breaking it down by where did things happen. So as a complement to the volume by price data out on the right side of the chart, what I've got in the chart here is this line to this line or this low to this high, I've got an anchored VWAP. So I'm drawing a VWAP that just represents from the first bar to the fifth bar of trading, because that's the first little swing move that I see. Then the next swing move that I see is in here, and that's also got an anchored VWAP. And the next move that I see is in here, and that's got an anchored VWAP. And you can see these are lining up with those support and resistance lines that we draw earlier in the session already, and telling me that those levels are actually the place that something pretty significant happened. There's a lot of volume going off right at that price level that we've identified as a support line. And that volume that's going off represents an area of order flow. That's where the institutions, that's where the market makers, that's where the big movers of this stock or of this index are placing their orders. And then we can go through and do a little validity check with our Fib study, and we can see, do we have some confluence? This is the trough to the peak of the first major move of the day there. And where does that line up with the support and resistance lines that we had on that last chart? And what we know is that 281.58 level was pretty close to where we had a support line. And that then if you look down at 281.01, that's right at the 50% retracement. That's the R2 pivot line. And I just use very simple Fib studies. So I just do the 382, the 50, and the 618. Those are the levels that I'm interested in. And then I do 1.382, 1.5, 1.618, and then I do the negatives as well. So we've got an expansion in either direction around the swing move that we saw, and then we try to go through and correlate those moves back to what we saw on the chart of support and resistance and volume by price and volume weighted average price. And what we see is that this area that's in a box here is the area that from probably 11:30 or so Eastern time up until the close of the market, I'm going to be focusing my attention on in the index. So of course, the index, looking at the NDX in this case, doesn't do you that much good, because the NDX is the index that you're representing. The correlation is going to be 1-to-1. You're going to be expecting the same magnitude move on the Qs as you are on the NDX. But where the NDX comes in handy is looking at those other trades that you had set up. And here you see it. So on this particular day, those levels did a really good job of picking off during the middle of the trading session where those inflections were going to happen. And all the trades that we're doing over the course of the day are based on a confluence of indications across these charts and across these time frames. I've got a daily up there, I've got a weekly. I've been looking at all these things to figure out where are the likely order flow inflections going to be, and where is it that I can expect something to happen. So here is a point on the chart, right at the central pivot line. And what you should see right away is it lines up with my support and resistance line, and it's sitting close to that Fib threshold. Over the course of the day, you should see lots of opportunities where these things came together. And it's just a really good habit to get into, to draw this stuff and don't even trade it. Just sit there and draw these things and put together a map like this for yourself of different time frames and different indications. I wouldn't put everything on one chart. So I would not put, like in that top chart there, you see I've got a volume weighted average price for the session. I've got my Fib studies, and the next chart down, I've got my logical support and resistance levels. I've got my volume weighted average price levels. And then on the right side on the bottom there, I've got a Gann fan. I like just seeing the angles that are predicted for the course of the day. And I've sort of got this whole picture painted here of what's going to happen. And for us right here, what we're interested in are the reactions to these Fib levels. So you can see at that point that I drew, right, we've got this level here at your central pivot inflection lines up with you've got confluence. You have the overlap between what's happening on the Fib study, what's happening with your pivot lines on the chart, what's happening with your support and resistance levels, and everything this is a picture perfect kind of a setup today. So this was today's trading. So there's trade number one that you can put off on the session. And it was later in the session, it wasn't for a couple hours, right, that we saw another inflection. So here we've got an inflection that comes down into the 382 level. That 382 inflection happens to overlap with this support and resistance level that we drew earlier. So that level was there. If you remember the last chart, it was there from early in the session. This is where we expected price to inflect. So we sit and we wait, and you wait, and you wait. And the hardest thing sometimes is getting my traders to keep their fingers off the keyboard. So we'll be working with these guys, and they want to see opportunity everywhere. And it's just not the case. You need to have 4 or 5 different things up. So I've got, like I said, the Qs, and I've got a bunch of other stocks up that I watch. And I am looking for everything to give me an overlap. Like the least important thing is probably going to be that chart in the bottom right, the GAN fan. You know, sometimes you feel like when you're using this stuff, it's getting close to pulling out the chicken bones to figure out what's going to happen in the market. But when you see a retracement like that comes right into one of those angles, what you do know is a lot of people look at that data. A lot of guys out there who are trading that stuff. And if you get to one of those points that happens to be an inflection that you're looking for, you've got a pretty good shot at a bunch of people are watching it, and that might be a self-fulfilling prophecy. Here's later in the day, and you see it happen again. So now we've moved beyond the levels that we had initially, and now we're into expansions. Now we're into the 382 and the 50 expansion on the chart. We've got a VWAP on the bottom chart there, the anchored VWAP, that says we've got a pretty high probability of, this level right here being a support, and of the move that tracks higher being dragged back into that volume weighted average price. So now we've got a bunch of things that are indicating that we could have another inflection and catch that wave move higher. So over the course of the rest of the day, we had another 2 opportunities to get into this thing. And you see that the move got you all the way up into R2. And R2 represents, it's kind of the case that on the indices especially, and especially if you start with an open that has any kind of relationship to the central pivot, that, once you're out to second resistance, that's probably going to represent the lion's share of the move that you're going to see higher, or if you're down to second support, that's going to be the lion's share of the move that you could see lower. But again, through the whole session, what you should catch from looking at these things, look at that top chart and look at where the retracement down to the 50 represented exactly the retracement that we had down to 297.67. Exactly. A perfect overlap there, a perfect confluence of indications saying this is a good place to place a trade. I did this trade live with one of our guys online this afternoon, and it was just an experiment. It was just a test of, can we manage to just stay in front of these things, sit here and watch for this thing to line up perfectly with this thing. And when we do, does that represent a significant opportunity for profit? And it did. So here you had it, 3 or 4 trades in the index that would be just a great way to spend any day of trading the index. And your biggest culprit in not catching these trades is impatience, where it's coming down, it gets close to one of the levels. And, well, I thought the market was about to reverse, and I thought this and I thought that. I've been doing this for 27 years, and I tell people all the time, I'm sorry, I've been doing this not 23 years. I tell people all the time, you need to focus your energy on why you want to stay out of a trade. The stuff that we were doing earlier in our career, so like 25 years ago, 26 years ago, the NYSE stuff, you were just looking for an indication that the prior sessions, momentum was going to continue, that the order flow wasn't done from the previous day. You were looking to hop on when institutions came in to buy the stock and get it into a mutual fund or whatever. and we still do that kind of trading, that's a different trade. This is all about waiting for the opportunity based on the liquidity. And that brings up really the psychology of this thing, which is, this is not about you need to be intuitive. This is about you need to be counterintuitive. So as price is moving higher, you are waiting for price to move lower. So the whole time that it's running up, you have no trade. You're watching this for 40 minutes sometimes, or for an hour sometimes, and it's just going up and it's killing you. It's killing half of these guys to watch it because they feel like they should be able to hop onto the opportunity. When the reality is, if we go and we pull back the curtain, really the way that Julie and I are getting in front of these opportunities is by waiting for them to come to us instead of chasing them. So that's actually all I have. I've got time for questions today for once. Again, if you want to sign up for the Volatility Band trading plan, you can. We've got these trades we put out every day, and every day you can follow along and see what it is that we did with them, follow the logic. It's a very, very logical progression of how you're getting into them and why you're getting in and why you're getting out. And then we just always got that stuff to back up the plan for the day and show you what it is that we did, why we did it, and let you compare it to what it is that you're doing. Okay. Any questions? Here we go. Well, there's a couple of you blowing our horn for us. That's very kind of you. But anyways, listen, it's good being here, and I guess I'm done a little bit early. I didn't think usually we get bombarded with questions via email. You can still send me a question via email. It's Adrian@TraderInsight.com. Right, so I'm happy to answer. And if not, I guess we're done a few minutes early here.